All right, let's dive into one of the most powerful and, honestly, one of the most misunderstood companies in all of tech, Broadcom. We all know it's a giant, a real titan. But what kind of titan is it really?
I mean, seriously, if you try to get a straight answer on what this company actually does, you're probably going to end up with more questions than answers. It just defies any simple, easy label. And that confusion, well, that's exactly what we're going to clear up today.
So is it an AI chip stock? You hear that all the time, right? And yeah, absolutely. It's custom silicon, it's networking gear, it's all totally critical to the AI revolution. But if you stop there, wow, you are missing almost the entire picture. Okay, then what about a software company? I mean, they did just make that massive acquisition of VMware. Software is a huge chunk of their revenue now. But calling it just a software company completely ignores where it came from. Its deep roots in hardware.
So maybe it's just a financial roll-up. A company that's just built by gobbling up other companies with a ton of debt? That's definitely part of the strategy, for sure. But that view completely misses the deep technological advantages, the moats that make them so dominant in the first place. The truth is, none of these labels even come close.
So to really get a handle on Broadcom, you have to look past all those simple tags and get to their core philosophy. See, it's not about being in every market. It's about owning and dominating the most critical intersections, the absolute choke points of our digital world.
And here it is. This is the whole game. Broadcom's entire strategy is to find, acquire, and then own the most important bottlenecks in technology. We're talking custom AI chips, essential parts in your smartphone, the vital software running a data center. If it's something you absolutely cannot do without, and it's incredibly hard to replace, that's what Broadcom wants to own.
Okay, so how does this incredible machine actually work? Well, the key is to stop seeing it as just one big company. You have to break it down. You have to see it as three distinct but deeply interconnected layers that all feed and reinforce one another.
The best way to think about it is like a three-story building. The ground floor, that's the stable, cash-gushing foundation. The second floor is the super high-growth AI engine. And that top floor, that's the machine that takes everything from below and just masterfully converts it into pure profit.
Let's start on that ground floor, layer one. This is the real unsung hero of the Broadcom story. It's this huge portfolio of essential chips for things like networking and broadband and storage. Now, these aren't the sexiest markets, they're not the fastest growing, but they are unbelievably durable and profitable, and they provide this rock-solid river of cash that fuels everything else the company does.
And having that stable base allows them to build layer two. Now just look at this number, $8.4 billion. That was Broadcom's AI-related revenue in a single quarter. This is the high-octane growth engine that has Wall Street so excited, and it's all built right on top of that steady foundation.
But here's the thing most people miss. Broadcom's AI play isn't just about making one chip to compete with GPUs. No. It's about owning the entire fabric that connects everything. They sell the custom chips, sure, but they also sell the switches, the optics, the connectors, all the essential stuff that ties thousands of those chips together into one giant AI brain. They figured out how to monetize the connections themselves.
And that brings us up to layer three. After that VMware deal, software is definitely not a side project anymore. It is over a third of the entire company. And what that does is give Broadcom this powerful, sticky, recurring revenue stream that acts as the perfect counterbalance to the normal ups and downs of the chip market.
This software layer, anchored by these giants like VMware, is just a massive cash flow generator. You can think of it as the financial brain of the whole operation. It takes all the profits from the hardware business and then strategically decides where to put that money. Is it another smart acquisition, or is it going right back to shareholders through dividends and buybacks? It's an unbelievably disciplined machine.
So, what happens when you stack these three layers on top of each other? Well, you get a financial engine that is unlike almost anything else in technology. Its ability to just turn revenue into pure spendable cash is, frankly, staggering. And here's the proof, right here. Just look at the numbers from a single recent quarter. $19 billion in revenue. That's impressive, sure, but that's not the real story. The real story is how that turned into over $13 billion in adjusted profit and an incredible $8 billion in free cash flow. That is efficiency at a scale that is just hard to comprehend.
If you want one number that says it all, it's this one.
a 68% adjusted profit margin. For a company that makes so much physical stuff, so much hardware, that is an absolutely elite world-class figure. It just speaks to this ruthless focus on profitability that's baked right into the company's DNA. A culture, by the way, largely built by its legendary architect and CEO, Hock. So we've seen how powerful this three-layer model is. But that brings up two really critical questions, right? How in the world do you value a company this complex? And maybe more importantly, what could actually go wrong? Because believe me, the risks here are just as significant as the strengths. And this is why just slapping a chip stock multiple on Broadcom is a huge, huge mistake. That method completely ignores the value of all that recurring software revenue and its incredible capital allocation skill. The right way to think about it is as a premium infrastructure platform, a category that just commands a much higher valuation.
But this platform is not invincible, not by a long shot. And this number highlights a major risk. 42%. In a recent quarter, that's how much of its entire net revenue came from just one single customer. That level of concentration, it creates a massive dependency. If anything happened to that one relationship, the impact would be just enormous.
And that's not the only thing to worry about. AI spending could turn out to be way more cyclical than people think. A new competitor could disrupt their networking dominance. There's also the massive question of the VMware integration. Can they really pull it off without upsetting customers? And finally, you just have to ask, after the stock's incredible run-up, is all the good news already baked into the price? These are the really tough questions investors are grappling with right now. So, look, if you take away just one thing today, let it be this. You have to look past the simple labels. Broadcom isn't just a chip company, it's a master monetizer of infrastructure itself, operating across hardware and software with a financial discipline that is truly in a class of its own. Which, of course, brings us to the ultimate question. Is this unique three-layered machine a work of durable, sustainable genius? Or is its incredible complexity, its reliance on these massive acquisitions and near-flawless execution, actually its greatest risk? That right there is the multi-billion-dollar question.